What's up, audit fans? Welcome to Amanda Loves to Audit, and today we're going to look at auditing non-current liabilities, specifically long-term bank loans that sit on the entity's balance sheet. They're really important because, of course, they're often weighing out the assets, and so making sure that our liabilities are appropriately classified, recorded at the correct value is critical for the audit, especially in these current pandemic times where we know that the going concern of businesses is a real issue. Cash flow and additional liabilities are what a lot of businesses are looking at to try and stay afloat right now. So let's get into it. Hi and welcome to Amanda Loves to Audit. My name is Amanda, I do love to audit, and I teach audit at a major Australian university to undergrads. So I've also had experience in the audit industry at Coopers & Lybrand and then PricewaterhouseCoopers, and I've worked with CPA Australia and Chartered Accountants Australia and New Zealand in promoting this fantastic profession called the accounting profession, and even better if you want to become an auditor. So today we're looking at auditing bank loans, and this is really important because loans are a significant source of funds for companies to be able to invest in a manufacturing facility, expand into another country. And remember, the other source where you might get investment is from issuing share capital, and we will have a video on auditing share capital and equity a little bit later on in the series. But bank loans is one I haven't really talked about on YouTube before, so I thought it was high time that we get into bank loans. So now I'm going to jump into my tablet and we'll get started. So today we're looking at bank loans, and typically we're going to see bank loans in our non-current liability section. Now, depending on the entity, you might see something in a smaller entity that does say bank loan, but more often you'll see something that just says borrowings. So that might be one loan, or it could be multiple loans put together, different loan facilities, especially in a big company. And for example, here you can look at Woolworths Limited, a major Australian supermarket and retail chain. They just have borrowings. So it's likely that they're going to have multiple loans in place here, and appropriate accounting valuation, allocation of those is really important. So in terms of what controls we would expect to see, then there's a certain number of things that we're going to look at. And I'm going to do these, let's do these in blue. Okay, so I'm going to start by writing the controls. So in terms of controls around the loan process, around trying to obtain finance from a loan, there's usually going to need to be some sort of process or a proposal for the loan. So the business can't just go out and get a loan and then expect the board of directors to try and just say, yep, sure, we'll get that loan, or we'll sign off on that loan. So there needs to be some sort of proposal for a loan, and we want to find out, what are we trying to fund? Is it some sort of capital expenditure? Is it something else? So there needs to be proposal for a loan, and then that loan needs to be approved. Or at least the first part of, okay, you need money, let's approve to go get usually some quotes for the loan. So you're not just going to go to potentially one lender, you might go to a number of different lenders and find out, this is how much I want to borrow, what is going to be the interest rate, what are going to be the terms, so how many years, and potentially, and really important to us, are there going to be any debt covenants? Is there anything that we're going to have to report? Will we have to provide financial statements? Will we need to maintain a certain ratio, for example, of current assets, a certain level of inventory? Are there any other restrictions, like perhaps you can't get another loan without this existing lender signing off on it? So we want to get some quotes on our options, because really all we're trying to do here is get our options for our loan. You might have a company that does do all of its business banking through one particular institution, but in the highly competitive nature of today, that's less likely. So somebody proposes a loan, the board, potentially if it's a large loan, might need to approve on the sign-off. For smaller loans, there might be different delegated approvals so that you can go get quotes and that process of investigation. Then once you have your options, you're going to need to make a choice. Which loan are we going to choose? So there needs to be those options and then a choice made. Now, individual organizations will have their own processes of which one to choose. Usually your finance department will make some sort of recommendation. So they will say, this is the loan that we think is best going to suit us. And then that recommendation typically needs to be approved by the executives, or potentially, if it's quite a big loan, by the board of directors. And of course, we would see that in the meeting minutes or somewhere else. So once the loan is approved, then we'll figure out the process of receiving the money. But the important other thing to remember is that we need to make sure that the recording of that loan, recording of the loan in the accounting system is done correctly. So in terms of what needs to be recorded, obviously we need to have that original amount of that loan. We're also going to need to make sure that we have journal entries and processes set up for our regular repayments set up. That might be done automatically as automatic journal entries when bank transfers are made. Is there EFT set up? And of course, if there are journal entries that are going to be recurring, so you set something up every month, the bank loan repayment journal entry automatically occurs, then there needs to be definitely a process to approve these recurring journal entries. In most systems, if you've got a regular bank account, regular repayments, you'd expect to see that a lot of this would be automated as part of the process. So it might be that the bank statement is automatically linked into your system, and when those bank statement transactions come in, then you automatically post those journal entries as well. So, the process and the controls are sort of, I've talked about all together here for the bank loan. So there needs to be, we don't want anybody to be able to get a bank loan. Who can get a bank, who can apply? What is the process? Who is the delegated authority to go and actually get the bank loan and sign for it? So in terms of testing the internal controls, I'm going to do these in a different color. Let's go with green here. Then for bank loans, this is where it gets a little bit tricky. And so while we have the controls, the question we have to ask ourselves is what sort of tests are we going to do? All right, because remember we have two types of tests. Option 1, tests of controls. Option 2 is to gather substantive evidence. So use substantive procedures. All right. Now, for most businesses where a loan is quite a big thing, so we need to ask ourselves, is it worthwhile to test internal controls around loans as well as gathering substantive evidence? From my perspective, really the question we need to ask ourselves is how many loans are there? All right. So how many loans, I guess in two separate ways. Number 1, all loans, and then also new loans. Now, if the business is really large, like Woolworths, has a lot of subsidiaries, then they might actually have quite a lot of loans made or paid back during the period. In that instance where there's a high volume, it probably does make sense to test the internal controls and then select a sample of the loans to substantively test. But if you were in an entity where they only had one loan this year and they only have 3 loans altogether, then it makes sense just to gather the substantive evidence and not actually test the internal controls. So if we were testing the internal controls, what would we do? Well, in a lot of instances, we'd probably go back and we'd look at these processes, map out the processes and say, okay, well, here's the flow diagram of what is supposed to happen. Let's select a sample of loans and let's check that there was a proposal made for those loans. Who approved it? Did we get the right number of quotes? Did the quotes contain all the relevant information? And then when they made a choice, was there the appropriate sign-off? So do we see something in the board meeting minutes? Do we see an official document? Do people have to sign something? Let's have a look at the actual contract. So that's looking at the process of controls. And realistically, like testing any control, we're trying to see if the review or approval or documentation that was required was actually collected. So those things would be mostly inspecting documents and checking that that was happening correctly. When it comes to substantive tests, instead we're going to need to think about, well, what are our assertions? So let's go to our assertions here. I'm going to just go on to a slightly new page here. So let's think about our assertions. Now we've got the borrowings, all right, and those borrowings we're going to have loan repayments. So we've got the balance of the loan as well as the repayments. And the borrowings also result in interest expense. All right, so our borrowings are going to sit on our balance sheet and our interest expense is going to sit on our P&L or our income statement. So here is where it gets tricky. Now we have to think about assertions related to the borrowings, balance assertions, and assertions related to the income statement, our transaction assertions. So let's handle the borrowings first. So when it comes to existence, remember existence is, was the bank loan real? Is it a real loan? So we're going to need to probably vouch. Remember, vouching is we start at the end and go back to the beginning. So I'm going to vouch a sample of bank loans from the accounts to the original loan contract. That's meant to say loan. Oh, let me write that again so that's more clear for you. Back to the original loan contract. So we want to make sure, is this related to a real loan? You could also compare to if it's a recent loan or identify the deposit of funds from the loan. All right, so if we said, oh, look, we're borrowing to build a new factory, then the bank would have given us, the $5 million, put it into our bank account. So can we identify the deposit of funds from that loan or any documentation of the loan execution? All right. So there should be something, that we could get from the bank. Now, the other thing that you could do here, and I'll write this in a different color so that it's really clear, is that you could obtain a bank confirmation. If you're already using an electronic confirmation service like confirmation.com, which is owned by Thomson Reuters, then if you're getting confirmation of bank accounts, it doesn't take much more to obtain a bank confirmation for the loans as well. So if you're using an electronic service like confirmation.com, then that bank confirmation, that's going to be super easy to prove that the loan really does exist with the specific lender. Now we move on to completeness, and I'll do these in a different color so that it's easy to distinguish between them. And completeness, I guess, is where we have one of our concerns, because we're most worried about businesses potentially understating their liabilities rather than overstating them. So this is really tricky because we have to try and find out, are there any loans that the company has that maybe are not recorded? So we might need to have some investigation. So this could be from reading the board meeting minutes, any new loans planned or recently approved. All right, now if you've been the auditor for a few years, You might know that last year they were planning to get a loan. This year you can ask them, did you get the loan? Where is the approval process? So we're trying to find potentially loans that they want us to potentially not find. So are they hiding loans? The other option here is they might try some sort of other off-sheet financing, off-balance sheet financing. So when they say off-sheet financing, they mean off-balance sheet financing that might still technically be a loan. So indicators of off-sheet financing or off-balance sheet financing or alternative forms of financing might be to see if there are any cash payments that don't match to accounts payable or existing loans. So if money is going out and you can't seem to figure out what it's going out for or where it's going out to, it could be a repayment on a loan that is not included. So that's something to remember. So completeness is really hard to test for. If you've got another great idea to test completeness, I'd love to hear about it in the comments. Please share with our community here. All right, so let's go on to accuracy and valuation. And again, accuracy and valuation is definitely an issue because, again, it could be underreporting. We could underreport the loan by miscalculating the interest or allocating the loan to the wrong type of account. This happened with Centro shopping centres where they allocated multi-billion dollars worth of current debt as non-current. And the company got into big financial strife when the non-current debt actually turned out to be due within the next 12 months. So in terms of accuracy, valuation, obligation, we're actually going to break it down into a few different areas because there are different parts to this. So let's look at the accuracy side. All right, so accuracy is about those individual repayments and journal entries of the repayments there. So when you might vouch a sample of loan repayment journal entries to source documentation. Such as the contract. Or, actually it should be and, the bank statement. All right, we can assume that the bank statement is going to be accurate there. So, correct date, correct amount. Now, when it comes to the valuation is something different. The valuation is, are all of these smaller entries and the total value of our loan and our loans correct? All right, so we're going to need to do a recalculation of a sample of loans to ensure the correct balance is reported. All right, you want to make sure they're not doing things like trying to capitalize interest or anything else that's a little bit shady. You could also, in terms of the valuation, trace loan statements to the loan accounts to match the reported end of financial year value. All right, the carrying value for that loan. So what is left to be paid. So there's a couple of ways that you can do this one. And then when it comes to allocation, remember allocation is about, is it a current or non-current liability? So with allocation and it comes to loans, remember the part that they're going to pay in the next 12 months, that's technically a current liability. And the rest that they're going to be paying later after 12 months is going to be a non-current liability. So check that loan, I can't spell here, I'm going berserk. Loan repayments for the next period are allocated to a current liability. and the remainder to non-current liabilities. All right, so that's really important that we do that just so that that's correct. We could also here check loan contracts for debt covenants to ensure they are still a non-current liability. And that's because if you've broken a covenant, then there is the potential that all of that money becomes due straight away and it needs to be recorded as a current liability rather than as a non-current liability. All right, let's move on to rights and obligations now. And remember, in this one, it's less rights, not so much rights, more about the obligation side of it. So again, we're going to be checking the loan contract to ensure that we do owe the bank funds. All right. Now, having an obligation is pretty easy. As soon as you sign the contract, you've got the obligation, but there might also be some terms that say like, we're going to lend you the money, but we're not expecting it paid back for a certain period of time. So there could be some things in the contract that might affect our obligations assertion, but it should mostly be the obligations is just, yep, they have a loan. As soon as the loan is made, then we have that obligation. So it's going to be that loan contract is there to prove that we have the obligation. And then the very last part is presentation. So remember, that's presentation of the loan in accordance with the relevant accounting standard. So really, it's checking the note disclosures. Disclosures meet the accounting standard requirements. And this is where you may get an accounting standard expert to help you review the notes to the accounts. And quite often they will give you, the draft financial statements first, but they're still preparing the notes. So you'll need to get a draft of what the notes look like and then go back to the accounting standard and say, okay, are they disclosing everything? Have they got the right information about risk, etc.? Because remember, this is an important part and quite a large part often of the company's balance sheet. So that is the whole process of the bank loan that lives as a liability on the balance sheet. Now remember back here, I said, well, hang on, we're going to have borrowings on the balance sheet, and then we're also going to have interest expense. So let's go down and let's do interest expense in a different color. So with interest expense, first we need to make sure, did we actually incur the interest expense and did that payment actually happen for us to have interest expense? So we're probably going to need to vouch a sample of interest expense journals to the bank statement. All right, and quite often it might be a bank statement, it could be an interest expense statement. All right, and that's going to prove that, yep, we've got a journal entry, we've got supporting document to match it. At the same time, with the same sample, what we're going to do is we're going to audit accuracy. So when vouching for occurrence, I can't spell, that's supposed to say occurrence, you know what I mean. Check that the amount in the journal and bank documentation matches. All right, so they've done the debit, or they've done the debit using the right number. Now, another procedure that we could do here, and I'm going to write down in a different color, is that if we're a little bit concerned that that number's not correct, is we could also recalculate the interest expense. All right, I would only do that though if you thought that this was quite a high risk of misstatement account, if you thought there were high levels of ROMs. which is risk of material misstatement, then that's where I would maybe go down the recalculation, but I'd probably just do that matching of that amount there. Now remember, of course, that in this instance, companies are probably trying to understate their expenses. So they're probably trying to make the interest expense look lower by potentially underreporting the amount, or perhaps not even recording the journal entries at all. So here, with completeness, we know that tracing is a good option. And remember, tracing is starting at the beginning, moving forward in time. So we could, rather than write tracing, I'm going to rewrite that there. That's not quite the best English. Trace a sample of interest repayments to the relevant journal entry. All right, so that might be that you have the bank statement, somebody has to prepare the journal entry, somebody has to then check it and approve it and post it. So you want to start with the bank documents. All right, tracing's moving forward, and this will help us identify, oh look, there are 5 interest payments that were made. Oh look, only 4 recorded in the journal, 1 is missing, let's rectify that. So we're going to trace that sample of interest repayments to the journal entry. Now when it comes to cutoff is about things recorded in the correct period. So where you may have interest, let's say the payment for the loan happens in the middle of the month, when is interest calculated, etc. So you're going to need to investigate when interest is charged and ensure journals are recorded in the period where interest is applied or levied or charged. All right, you don't want them saying, oh, for the interest for the last month, I'm just going to push that into the next month. So you want to make sure that it's usually around the end of the financial period. So this, you would say sample around, let's say here, a month on either side of the end of the financial year. EOFY equals end of financial year. So if you're looking at a June 30 year end, let's look at those journals for June and for July to make sure that nothing is in the incorrect period. All right, classification is about journal entries. So when we're doing our other journal entry tests, so when we're tracing, for example, so when tracing, check that the journal entries, I'm going to scroll this up here, are using the correct account code from the chart of accounts. Remember, the chart of accounts is your master list, and it's not just that it has like assets, revenues, expenses, liabilities, there'll be subcodes. So if you're a company like Woolworths that has lots of subsidiaries, they all have loans, there'll be a specific account code for that subsidiary and that specific loan. So we need to make sure that it's doing the debit and the credit to the right place. So those are my examples of how we can audit bank loans and borrowings by testing controls or by testing substantively. Of course, this is not an exhaustive list. If you've got another great suggestion on how we might test a control or test substantively for borrowings and bank loans, I'd love for you to share it with our community in the comments. Of course, if you have an account you'd like me to analyze in this series, please also pop it in the comments. Thanks for watching. If you haven't already, consider subscribing, and I'll see you next time. Stay safe and stay well.